Every day, I get asked, is now a good time to buy? When the market goes up, people get FOMO. When it drops, fear takes over. It's a constant tug of war that makes investing feel complicated. We all wish we had a crystal ball, but even Wall Street experts don't. Buying the dip sounds easy. Buy low, sell high. But timing the market is tough, and dips can keep dipping. Instead, focus on a long-term strategy that works for you, no matter what the market does. Let's break down what an ETF is, without the jargon. Think of it like a basket of groceries. Instead of picking each item, you buy a basket with a bit of everything. An ETF is just like that, but with stocks, bonds, or other assets. For example, an S&P 500 ETF holds pieces of the 500 largest US companies. If you only buy one stock, like Tesla, your risk is high. With an ETF, you own hundreds of companies at once, so your risk is spread out. ETFs are easy and cheap to buy or sell with very low fees. That's why ETFs are one of the best tools for building wealth. Simple, low cost, and accessible to everyone. Let's talk about buying the dip, a strategy where you buy investments like ETFs after their prices drop. The idea is simple. Buy when prices are low, hoping they'll recover and reach new highs. It's like grabbing your favorite item on sale, expecting its value to bounce back. If you get it right, the rewards can be huge. For example, buying an ETF at $80 that rebounds to $100 is a 25% gain. But beware, what looks like a small dip could become a bigger crash. Sometimes trying to catch a bargain is just catching a falling knife. On the other side of the coin, we have the strategy of waiting. This doesn't necessarily mean sitting on your cash forever, but rather being patient and not rushing into the market just because there's a small dip. Sometimes the wisest move you can make is to do nothing at all. Waiting allows you to gather more information, see if a downward trend is stabilizing, or simply give yourself time to make a decision without being driven by emotion. It's about avoiding the knee-jerk reaction to every little market fluctuation and instead focusing on the bigger picture. One of the main reasons waiting can be smart is that it helps you avoid the falling knife scenario we just talked about. A 5% drop in the market might seem like a buying opportunity, but if it's followed by another 5% drop and then another, the person who waited is in a much better position. They preserve their capital and can now buy in at an even lower price. Patience allows you to let the dust settle. It's a defensive strategy that prioritizes protecting your money over chasing potentially quick but risky gains. Think back to the dot-com bubble burst in the early 2000s. The market started to decline, and many people bought the initial dips, thinking they were getting a great deal on tech stocks. However, the market continued to slide for nearly 2 years. Those who jumped in early saw their investments shrink significantly. The patient investors who waited for clear signs of a bottom and a sustained recovery might have missed the absolute lowest point, but they also missed the majority of the painful downturn. They entered the market when the risk was substantially lower. Furthermore, waiting can simply mean sticking to a predetermined investment schedule, which we'll discuss more later. It's a form of disciplined patience. Instead of trying to time your buys perfectly, you simply invest a set amount of money at regular intervals, like every month. This removes the stress and anxiety of trying to decide whether now is the right time. You aren't really waiting in the sense of doing nothing. You are patiently and consistently executing your long-term plan, which is often the most effective and stress-free way to build wealth over time. We've explored buying the dip and waiting for the right moment, Both are just forms of market timing. The dream? Get in before the market rises. Get out before it falls. If you could do this consistently, you'd be rich. But timing the market means being right twice. When to get out and when to get back in. Miss just a few of the best days, and your returns can suffer dramatically. Even professionals rarely succeed at this game. For most of us, trying to predict the unpredictable is a recipe for stress and disappointment. Time in the market beats timing the market. So, if trying to time the market is a fool's errand, what should you do instead? The answer is beautifully simple and incredibly effective. Dollar cost averaging, or DCA. This strategy involves investing a fixed amount of money into a particular investment, like a broad market ETF, on a regular schedule, regardless of what the market is doing. It could be $100 every week, $500 every month, or $2,000 every quarter. The key is consistency. You set it up, automate it, and let it run in the background. The magic of dollar cost averaging is that it completely removes emotion and the impossible task of market timing from the equation. When the market is up, your fixed dollar amount buys you fewer shares of the ETF. When the market is down, during a dip, that same fixed dollar amount automatically buys you more shares. Over time, this strategy can lower your average cost per share, and you naturally buy more when prices are low and less when prices are high, without ever having to think about it. It's the perfect way to take advantage of dips without the stress of trying to time them. There are a few common mistakes to avoid with this strategy. The first is panic selling. When the market drops, your account value will go down. This is normal. The worst thing you can do is stop your contributions or sell your investments at a loss. You have to trust the process and remember that these downturns are when your dollars are working the hardest, buying more shares at a discount. The second mistake is not starting because you think you don't have enough money. The power of this strategy is in consistency, not the amount. Even starting with $25 a week builds the habit and gets compounding to work for you. Ultimately, the best strategy is one that you can stick with for the long haul. Think in terms of decades, not days or months. By consistently investing in low-cost diversified ETFs through dollar cost averaging, you are aligning your success with the long-term growth of the global economy. It is not flashy. It won't make you a millionaire overnight, but it is a proven stress-free path to building substantial wealth. Keep learning, stay consistent, and let time do the heavy lifting for you. That's how you win the game.